The mirage of power in the late 1990s, Enron wasn't just a company. It was a myth, a shimmering tower of glass and ambition that reflected the blinding Texas sun, promising to lead America into a bold new century of energy innovation. Its name echoed through Wall Street like a hymn to capitalism, praised by presidents, adored by analysts, and worshipped by investors. On paper, Enron was untouchable, the seventh largest corporation in the United States, valued at over $74 billion. But behind those glass walls, the foundation was rotting. The numbers were illusions, the profits fabricated, the innovation nothing more than a counting sleight of hand. While the world applauded, a quiet countdown had already begun. And when the clock hit zero, the explosion would shatter more than just balance sheets. It would destroy lives, erase fortunes, and leave a permanent scar on corporate America. Chapter 1, The Golden Ascent Enron story, begins in 1985, in the midst of an energy sector shakeup. Two pipeline companies, Houston Natural Gas and Internorth, merged to create a single massive entity. At the helm was Kenneth, a polished, politically connected executive who understood both the technical side of the energy industry and the energy industry and the theater of high finance. From the very beginning, Lay's vision wasn't just about moving natural gas through steel pipes. He wanted Enron to become the Amazon of energy, a diversified powerhouse that would dominate the market not only in physical resources, but in trading energy like a commodity. The idea was revolutionary. Instead of simply selling gas, Enron would act as a middleman, buying and selling energy contracts, making profits off volatility itself. The 1990s were fertile ground for such ambition. Deregulation was sweeping across the United States, particularly in the energy industry. Rules that had once tightly controlled utility prices and monopolies were falling away, replaced by free market competition. For Enron, this meant opportunity, and Lay moved fast to seize it. Enter Jeffrey Skilling, a McKinsey consultant who would become Enron's intellectual architect. Skilling brought with him an aggressive new way of thinking about business, the asset-light model. Enron wouldn't need to own massive amounts of physical infrastructure. It would make its money through trading, speculation, and complex financial contracts. This wasn't about pipelines anymore. It was about turning electrons, gas molecules, and bandwidth into products on a stock exchange. By the mid-1990s, Enron was expanding into electricity, broadband, and even international projects. Its headquarters in Houston became a symbol of American corporate power, modern, gleaming, and full of young, ambitious traders who treated energy markets like a high-stakes casino. The company's culture was one of aggression, innovation, and absolute confidence, and it worked. Revenue soared from $9 billion in 1995 to more than $100 billion by 2000. The company's stock price skyrocketed, making millionaires out of executives and longtime employees. Business magazines declared Enron the most innovative company in America for 6 years running. To the outside world, it was a perfect corporate success story. But even in those golden years, seeds of destruction were being planted. To keep Wall Street happy, Enron needed its profits to grow every single quarter. And when real profits weren't enough, they found other ways to make the numbers look good. Chapter 2, Behind the Curtains from the Outside. Enron's financial statements sparkled with promise. But inside, deep in the labyrinth of accounting departments and secret subsidiaries, a different reality existed. At the heart of this deception was mark-to-market accounting, a method that allowed Enron to record potential future profits as if they were real right now. If Enron signed a 20-year contract to supply electricity, they could estimate the total profit over 2 decades and then book it immediately, even if the actual cash wouldn't appear for years. On paper, this created explosive growth. In Reality, it was a dangerous illusion. Andrew Fastow, Enron's ambitious chief financial officer, took this a step further. He engineered a web of special-purpose entities, SPECs, essentially shell companies that could hold Enron's debt off its balance sheet. These SPEs allowed Enron to hide billions in losses and risky investments from shareholders and regulators. The company could borrow heavily, fail miserably, and yet still report record-breaking profits to Wall Street. Inside Enron, this wasn't just tolerated, it was celebrated. The culture rewarded short-term gains over long-term stability, and employees quickly learned that making the numbers look good was more important than making the business healthy. If you hit your targets, you were rewarded with massive bonuses. If you didn't, you were out. Meanwhile, Lay and Skilling were building Enron's public image into something larger than life. The company sponsored sporting events, built grand skyscrapers, and marketed itself as the pioneer of a new economic age. Employees were told they weren't just selling electricity, they were changing the world. But outside the glass tower, cracks were forming. Journalists began asking questions about Enron's complicated financial structures. Analysts struggled to understand how the company made so much money in so many different industries. Competitors noticed that Enron's trades often seemed designed to benefit Enron first, and its customers second. Inside the company, some employees were starting to whisper. The pressure to keep profits climbing had turned the workplace into a moral minefield. Traders manipulated California's energy market to create artificial shortages, driving up prices while blackouts rolled through neighborhoods. Enron made millions from the chaos, but the public paid the price. The curtain was still drawn. The stage lights were still bright, but the shadows behind Enron's smiling public face were growing darker by the day. Chapter 3 cracks in the empire. By the year 2000, Enron had reached what many considered its peak, a global powerhouse with over 20,000 employees, operations in more than 40 countries, and a reputation for being the most innovative company in America. Its stock price hovered around $90 per share. Its executives graced the covers of financial magazines, and politicians from both parties praised it as the future of the free market. But while the skyscraper shined in the Texas sun, hairline fractures had begun to snake their way through its foundation. They were invisible to most outsiders, but inside the company, a few people could feel the tremors. These cracks were not caused by one catastrophic mistake, but by the relentless accumulation of risk, arrogance, and moral compromise. The illusion of endless growth. Wall Street's expectations had become a noose around Enron's neck. The company had trained investors to expect double-digit growth every single quarter. Missing those numbers wasn't an option. It would send the stock price tumbling, hurt executive bonuses, and trigger panic among shareholders. To maintain this illusion, Enron's executives leaned harder into mark-to-market accounting. New projects were announced with grand fanfare. Contracts were signed, and within days, sometimes hours, billions in future profits were booked into the current quarter. The problem was that many of these projects were shaky at best and outright failures at worst. But to the accounting books, they looked like gold. Inside the trading floors, the culture was a heady mix of youthful aggression and dangerous overconfidence. Enron's traders believed they were smarter than anyone else in the room. Regulators, competitors, even the market itself. They thought they could bend reality to their will. And in a way, they could. For a while, California, the turning point. One of the most visible cracks in Enron's empire emerged in California's deregulated energy market in 2000 and 2001. Deregulation had allowed private companies like Enron to compete in selling electricity, but the system was poorly designed. And Enron's traders quickly learned how to exploit it, using schemes with code names like Death Star, Ricochet, and Fat Boy. Traders deliberately manipulated the supply of electricity. They would schedule fake power transmissions to create congestion on the grid, then get paid to relieve that congestion. They would withhold power from the market to drive prices up, then sell it back at obscene profits. These tactics caused rolling blackouts across the state. Millions of Californians sat in the dark. Traffic lights went dead, businesses lost millions, and elderly residents suffered in the summer heat. Meanwhile, inside Enron's Houston headquarters, traders joked about it on recorded phone calls, laughing about Grandma Millie sitting in the dark while they made millions. The scandal didn't erupt immediately, but it planted a dangerous seed, a growing public and regulatory suspicion that Enron's success wasn't as clean as it seemed. Jeffrey Skilling's sudden exit in August 2001, the first true shockwave hit. Jeffrey Skilling, the brilliant, sharp-tongued CEO who had been Enron's visionary, abruptly resigned after just 6 months in the top job. Officially, Skilling cited personal reasons. Unofficially, rumors swirled. Some insiders believed Skilling had seen the iceberg on the horizon and decided to jump ship before the collision. His departure rattled investors. If the man who built the empire was leaving so suddenly, what did he know that they didn't? Kenneth, who had stepped down as CEO earlier that year, returned to the role, but Lay was more of a political figurehead than a hands-on operator. Without Skilling's aggressive energy and strategic mind, Enron's complex machine began to sputter. The whisper campaign in financial circles, whispers about Enron's opaque finances, grew louder. Analysts and journalists began asking pointed questions. Why were Enron's financial statements so hard to understand? How did it make so much money? In industries it barely seemed to operate in? Why did it rely so heavily on off-balance sheet partnerships? One journalist, Bethany McLean of Fortune magazine, wrote a now famous article in March 2001 titled, "Is Enron Overpriced?" In it, she pointed out that no one, not analysts, not investors, could clearly explain how Enron made its profits. The article didn't crash the stock overnight, but it was like the first hairline crack appearing on the glass of a skyscraper. Andrew Fastow's house of cards, behind the scenes, CFO Andrew Fastow's network of shell companies, was becoming harder to manage. These special purpose entities, with names like LJM-1, LJM-2, and Raptor, had been created to hide Enron's debt and keep losses off its books. But they also enriched Fastow personally, creating a massive conflict of interest. The complexity of these deals was staggering. Some partnerships bought failing Enron assets at inflated prices, making it look like Enron was making a profit. Others borrowed billions using Enron's own stock as collateral, a risky move that would prove catastrophic once the stock price began to fall. By mid-2001, Fastow was struggling to keep all the plates spinning. The debt was growing, the hidden losses were mounting, and the partnerships were consuming more and more cash just to keep the illusion alive. The stock price falters in late summer 2001. Enron's stock price began to slip. At first, it seemed like a minor correction, the kind of market fluctuation every big company experiences. But then came the credit downgrades, the missed earnings targets, and the rumors of SEC interest in Enron's accounting practices. As the stock fell, the danger of Fastow's partnerships became clear. Because so many of the deals were tied to Enron's stock price, a sustained drop triggered a chain reaction. Collateral had to be increased, debt had to be repaid. Cash that Enron didn't have began bleeding out of the company at an alarming rate. Inside the headquarters, the mood shifted from swagger to silent panic. Traders still smiled in public, but in private, executives were running out of moves. It was like playing chess against the market, with only pawns left on the board. The media smell. Blood. By October 2001, investigative reporters had moved in like sharks. The Wall Street Journal began publishing a series of damning articles detailing Fastow's partnerships and questioning Enron's accounting. Each story chipped away at investor confidence, and with every new revelation, the stock price sank further. Enron tried to spin the narrative, holding upbeat conference calls and issuing optimistic press releases. But the gap between the company's public statements and the reality inside was now too wide to hide. The empire that had taken 16 years to build was about to collapse in less than 3 months. Chapter 4. The Collapse by October 2001. The scent of blood was in the water. Enron, once the darling of Wall Street and the golden child of American capitalism, was now surrounded by predators, journalists, regulators, short sellers, and skeptical investors, all circling, all waiting for the kill. Inside the company's sleek Houston headquarters, the panic was no longer hidden. Boardroom doors were shut tight, phones rang without answer, and behind every polite public smile was the same unspoken thought: it's over. October 16th, 2001. The first admission on this date. Enron finally dropped a bombshell it could no longer hide. The company announced a $618 million third-quarter loss and disclosed that it would take a $1.2 billion charge directly to shareholder equity. The loss itself was alarming, but the real shock came from the reason behind it. The charge was tied directly to partnerships run by CFO Andrew Fastow. For the first time, Enron admitted publicly that these mysterious off-balance sheet entities were intertwined with its finances. Investors didn't fully understand the complexity, but they understood enough to know it was bad. Very bad. The market's response was immediate. Enron's stock, which had been trading at around $33 earlier in the month, fell to under $20. In days, credit rating agencies began muttering about potential downgrades. And behind the scenes, Enron's debt obligations, many of which were triggered by stock declines, started to tighten like a vice. The SEC moves in 3 days later. On October 19th, the U.S. Securities and Exchange Commission, SEC, announced it had opened a formal inquiry into Enron's accounting practices. This wasn't a casual look. It was a flashing red warning light. Fastow became the center of the investigation. His network of shell companies, LJM1, LJM2, the Raptors, was now in the public eye, and the conflict of interest was glaring. He had personally profited millions from deals with the company he was supposed to serve. Inside Enron, the tension between Fastow and other executives exploded. Skilling was gone, Lay was floundering, and Fastow was fighting to keep his position. But by October 24th, the decision was made. Fastow was out. His resignation was announced, but the move did little to restore confidence. The liquidity crisis. If Enron had been a healthy company, losing Fastow might have been a cleansing moment. But by late October, it wasn't about leadership anymore. It was about survival. Enron's stock price collapse had triggered billions of dollars in debt repayment clauses. Lenders demanded collateral. Partners demanded cash. And the cash simply wasn't there. The company's business model, once praised as asset-light and innovative, now revealed its fatal flaw. It depended entirely on constant market confidence. Once that confidence was gone, Enron had almost nothing tangible to fall back on. Lay and his top executives scrambled to find a buyer. They approached Dynegy, a smaller rival energy trader, with an offer to sell the company for $9 billion. For a brief moment, it seemed like salvation was within reach. Dynegy agreed in principle, calling the merger a perfect strategic fit. But that illusion shattered quickly. November. The death spiral as November began. The news worsened daily. On November 8th, Enron announced it would restate its financial results for the previous 4 years, erasing $586 million in reported profits. This wasn't just a red flag. It was a screaming siren that the books had been cooked. The restatement confirmed what critics had long suspected. Enron's profits were largely an accounting mirage. Debt that had been hidden in off-balance sheet entities now came flooding back onto Enron's books, revealing billions in liabilities. The market reacted violently. Enron's stock plunged into single digits. Dynegy began to backpedal, sensing they were about to buy a corpse instead of a crown jewel. Credit rating agencies, Moody's, S&P, Fitch finally cut Enron's debt to junk status. The downgrade was catastrophic, triggering another round of debt repayments that Enron couldn't meet. The company's liquidity dried up almost overnight. The Dynegy deal collapses on November 28, 2001. Dynegy officially pulled out of the deal. They cited adverse changes in Enron's business, a polite corporate euphemism for "this company is about to die." When the announcement hit, it was like a switch flipped. Whatever faint hope remained vanished instantly. Enron's stock fell below $1. Employees who had seen their retirement accounts swell into millions just a year earlier now faced financial ruin. Some lost everything. The final days, the last week of November, was a blur of desperate phone calls, closed-door meetings, and futile attempts to raise emergency financing. Enron's headquarters, once buzzing with ambition and bravado, was now a ghost tower of empty cubicles and silent corridors. Employees cleaned out their desks under the watch of security guards. Rumors flew about FBI raids, mass layoffs, and looming arrests. Lay, who had been the face of Enron's rise, now became the face of its collapse, his once confident smile replaced by a grim, defensive glare. On December 2, 2001, Enron filed for Chapter 11 bankruptcy. With $63.4 billion in assets, it was the largest corporate bankruptcy in U.S. history at the time. The filing sent shockwaves through the global economy, erasing billions in shareholder value and destroying the savings of thousands of employees. The fallout, the collapse, triggered a political firestorm. Congressional hearings dragged executives into the spotlight, forcing them to answer or dodge questions under oath. Lay, Skilling, and Fastow became household names for all the wrong reasons. Fastow eventually pleaded guilty to fraud and served more than 5 years in prison. Skilling was convicted on multiple counts of conspiracy, fraud, and insider trading, receiving a 24-year sentence, later reduced. Lay was convicted as well, but died of a heart attack before sentencing. The scandal also destroyed Arthur Andersen, one of the Big Five accounting firms, which was found guilty of obstruction of justice for shredding Enron-related documents. The conviction was later overturned, but by then, the firm was dead. Tens of thousands of employees worldwide lost their jobs. In the end, the Enron debacle wasn't just the story of a single company's collapse. It was a lesson in the dangers of unchecked corporate greed, the fragility of market trust, and the human cost of financial deception. Chapter 5, Aftermath and Legacy. The shockwave. December 2, 2001, was a Sunday, the kind of quiet, gray winter day that Houston rarely sees. But for the 20,000 people who worked for Enron, it felt like a funeral. The headlines were brutal, the numbers unthinkable. $63.4 billion in assets wiped out. Overnight, Enron had gone from the crown jewel of the energy industry to the largest bankruptcy in U.S. history. The shockwave traveled far beyond Texas. Across America, pension funds that had trusted Enron stock as a blue-chip anchor suddenly found massive holes in their portfolios. Mutual funds bled value. Municipalities that had invested retirement money for firefighters and teachers saw decades of savings vanish. In Houston, the collapse didn't just bankrupt employees, it gutted an entire community. Restaurants that relied on corporate accounts went quiet. Real estate prices dipped as former Enron workers scrambled to sell homes they could no longer afford. And for thousands, the Enron logo, once a badge of pride, became something to hide. The human cost inside Enron, loyalty, had been almost religious. Employees were encouraged, pressured even, to invest their retirement savings into company stock. For years, that gamble had paid off. Enron's meteoric rise had turned secretaries into millionaires on paper. Some employees even joked. At their 401k, us were 401 Enrons. But when the collapse came, those same retirement accounts were locked. Executives at the top quietly cashed out millions in stock before the crash, but ordinary workers were frozen out, unable to sell as the share price plummeted from over $90 to less than $1. By the time restrictions lifted, it was too late. Everything was gone. One former employee, a single mother who had worked in Enron's accounting department for 12 years, told reporters she'd lost not just her job, but her entire $780,000 retirement fund. Another worker, a security guard, had invested every spare dollar into Enron stock because the bosses told us it was the best investment in the world. He retired with less than $1,200. The psychological toll was just as severe. In the months after the bankruptcy, there were reports of depression, divorces, and even suicides linked to financial ruin. Enron wasn't just a company that failed. It was a family that turned on its own. Wall Street's reckoning on Wall Street. The mood was one of disbelief and fear. Analysts who had once been Enron's cheerleaders were now forced to explain how they had missed the iceberg entirely. Investment banks scrambled to assess their own exposure, with some writing off hundreds of millions in Enron-related losses. The scandal embarrassed not just traders, but entire institutions. Merrill Lynch, J.P. Morgan, and Citigroup faced lawsuits for their role in enabling Enron's deceptive practices. Some had helped structure the very partnerships that hid the company's debt. Politicians, too, found themselves in the blast radius. Enron had been one of the most politically connected corporations in America, donating generously to both Republican and Democratic campaigns. Kenneth had been a personal friend of President George W. Bush, and photographs of the two together suddenly became political poison. Lawmakers scrambled to distance themselves from a man they had once courted for campaign contributions. Arthur Andersen's fall of Enron was the central figure in this corporate tragedy. Arthur Andersen was its chief enabler. As one of the big five accounting firms, Andersen had a global reputation for integrity, a reputation that evaporated almost overnight. Investigators discovered that in the weeks leading up to the bankruptcy, Andersen employees had destroyed thousands of Enron-related documents. Shredders ran so often in Andersen's Houston office that they overheated. Emails instructed staff to follow the document retention policy, a euphemism that everyone understood. In 2002, Arthur Andersen was found guilty of obstruction of justice. The conviction was later overturned by the U.S. Supreme Court, but the damage was irreversible. Clients fled in droves. By the end of the year, Arthur Andersen ceased auditing public companies. More than 85,000 employees worldwide lost their jobs. The fall of Andersen sent a chilling message. The watchdogs had been asleep, and in some cases, they'd been feeding from the same bowl as the wolves. Sarbanes Oxley, the legislative backlash Enron's collapse, along with the fall of WorldCom the following year, forced Congress to confront a question it had avoided for decades. How do you stop corporate America from cooking its books? The answer came in July 2002 with the Sarbanes-Oxley Act, SOX, a sweeping corporate reform law that fundamentally changed how companies reported their finances. Among its provisions, CEO and CFO certification, top executives now had to personally sign off on the accuracy of financial statements, stricter auditor independence. Accounting firms were banned from offering certain consulting services to audit clients. Internal controls. Companies had to establish and document systems to prevent fraud, with penalties for failure, criminal penalties. Executives who knowingly signed false reports faced up to 20 years in prison. Supporters hailed SOX as the death knell for Enron-style fraud. Critics argued it burdened honest businesses with costly compliance. But one thing was clear. Without Enron, SOX might never have existed. Cultural impact. Enron in the public. Imagination. The word Enron quickly became cultural shorthand for corporate greed and deception. Late-night hosts termed Kenneth, Lay and Jeffrey Skilling into punchlines. Cartoons depicted the Enron E logo as a sinking ship. Books like The Smartest, Guys in the Room, and the documentary of the same name dissected the scandal in forensic detail. Business schools built entire courses around the case, using Enron as a warning of what happens when ambition outruns ethics. Even years later, the echoes lingered. When Lehman Brothers collapsed in 2008, journalists called it another Enron. When cryptocurrency exchange FTX imploded in 2022, comparisons to Enron filled headlines. The specifics differed, but the pattern: rapid rise, complex financial structures, sudden collapse, was hauntingly familiar. Lessons learned and forgotten. Enron's story should have been a permanent cautionary tale. It showed that transparency is non-negotiable in a functioning market. Incentive structures drive behavior. If you reward short-term gains, you get short-term thinking. Regulatory gaps will be exploited until they close. And sometimes, even after yet, the decades since have shown that the lessons didn't fully stick. The 2008 financial crisis, the Wells Fargo fake account scandal, the Toronto's fraud, and countless smaller corporate implosions all followed similar arcs. The truth is uncomfortable. Markets have a short memory, and greed has a long half-life. Enron wasn't the first to fall this way, and it won't be the last. Epilogue: the ghost in the tower today, the site of Enron's former headquarters in downtown Houston, stands as just another office building, stripped of its name and legacy. The gleaming glass tower reflects the Texas sun exactly as it did in the 1990s. But for those who remember, it casts a shadow that can't be erased. For the employees who lost everything, for the investors left holding worthless stock certificates, and for the families whose futures were rewritten in bankruptcy court, Enron is more than a cautionary tale. It's a wound that never fully healed. Closing in the end, the rise and fall of Enron wasn't just about accounting fraud or corporate arrogance. It was about trust. Trust in markets. Trust in leadership. Trust that the system is built to protect the many, not enrich the few. So the question remains, if the smartest guys in the room could get away with it for 16 years, how sure are we that it isn't happening again right now? If you found this story worth your time, subscribe for more deep dives into the hidden histories of corporate empires and the lessons they leave behind.